Here are the crypto top headlines covered in this video. Bitcoin and crypto suddenly braced for a powerful Apple iPhone wallet update after price swings. Next, lower interest rates could be the key to DeFi summer, says HashKey CEO. Also, Franklin Templeton files S1 for new crypto index ETF. Welcome to Crypto Top Headlines, where there's no clickbait thumbnails or titles, and no speeches on my opinions, just bringing crypto's news to you. I would greatly appreciate it if you would click on the like and subscribe buttons, as well as the notification bell. It does help support the channel, so thank you in advance for doing so. Now, on to these headlines. Our first top headline: Bitcoin and crypto suddenly braced for a powerful Apple iPhone wallet update after price swings. Bitcoin and cryptocurrencies have been given a shot in the arm this year by first a huge Wall Street earthquake and then the surprise embrace of former President Donald Trump. The Bitcoin price surged back to over its previous all-time high earlier this year, topping $70,000 per Bitcoin before falling back, though many still expect a Bitcoin price boom before the end of 2024. Now, after a leak primed the Bitcoin and crypto market for a U.S. crackdown, iPhone maker Apple has announced a major change to its Apple Wallet, described by one crypto chief executive as a powerful update. Apple has said it will begin letting third-party developers use the iPhone's Near-Field Communication, or NFC, payment chip to handle transactions following a multi-year pressure campaign from regulators in Europe for the company to open up the platform. iPhone users will be able to choose a third-party payment app as their system default, and possibly one that supports Bitcoin, crypto, or stablecoin payment options. Stablecoins, the largest of which are Tether's USDT and Circle's USDC, are cryptocurrencies price-pegged to traditional currencies, usually the US dollar. Tap to pay using USDC on iPhones incoming soon. USDC stablecoin developer Circle's chief executive Jeremy Allaire posted to X, telling wallet devs to start your engines. Allaire went on to explain what the update will mean for developers and point-of-sale hardware/software companies and how they should prepare. This would allow a point-of-sale to tell an iPhone what blockchain address it will accept USDC on, or the amount to pay, and then the iPhone-based wallet app could prompt the user to confirm a payment, like with Face ID, and initiate a transaction over the blockchain to settle the USDC, Allaire said. Combining this with high-performance and low-fee blockchain networks, most these days, this will open up a powerful pathway for direct-to-merchant USDC payments. Apple will still require developers to pay associated fees to use the NFC chip and enter into a commercial agreement that means only authorized developers who meet certain industry and regulatory requirements and commit to Apple's ongoing security and privacy standards can access the system. Apple said it will roll out the program in Australia, Brazil, Canada, Japan, New Zealand, the US, and UK, without mentioning the European Union, which has pushed hardest for the change. Let me pause here for a moment. If you're getting value out of this video, please click on the like and subscribe buttons as well as the notification bell. Our next top headline: lower interest rates could be the key to DeFi summer, says HashKey CEO. Declining interest rates, along with rising investment in Bitcoin, could provide the fuel the DeFi market needs to experience a long-awaited resurgence. It's been a wild ride in the markets in recent days. The United States Federal Reserve is forecast to cut interest rates in 2024, but uneven inflation prints and a somewhat contradictory jobs market have created a lack of consensus on the total number of rate cuts for the remainder of the year. As we contemplate where the market goes from here, speculation remains around the question of what the Federal Reserve has in store. So, what are some potential outcomes from interest rate cuts? let's explore the impact on a few areas of the crypto industry. Return of risk-on assets. As rates come down, the resultant weakening of U.S. Treasury yields are likely to strengthen the spotlight on riskier but higher yield opportunities elsewhere, and that means investors will likely have a greater appetite for cryptocurrencies. This uncertainty puts the focus on Bitcoin, which is typically seen as a risk-on asset. When interest rates drop, investors pile into riskier asset classes. That may not always be the case, as ARK Invest CEO Cathie Wood pointed out during our fireside chat at the Hong Kong Web3 Festival earlier this year. She expressed her belief that Bitcoin could actually function as a risk-off asset, citing its success amid currency devaluations in emerging markets around the world. DeFi returning. The long summer of decentralized finance, or DeFi, in 2021 was a pivotal moment for Web3, the second major bull market following the 2017 ICO boom. During this phase, lots of critical DeFi infrastructure came on-chain, particularly on Ethereum. All told, its total value locked, or TVL, increased by around 2,100% from roughly $700 million to $15 billion. But today's DeFi landscape is increasingly focused on another ecosystem, Bitcoin. Against a backdrop of reduced interest rates, investors may be drawn to higher yields on the network and its growing number of layer 2s. So much so that I believe Bitcoin will power the next DeFi summer. There's excitement about the evolving BTC-FI movement that is different from the buzz around the asset as an inflation hedge. As well as the bullish ETF approvals earlier this year, Bitcoin's DeFi ecosystem is also booming, triggered by last year's launch of ordinals, followed by runes, and a wave of yield-bearing protocols on EVM-compatible scaling solutions. And Bitcoin is also gaining utility and interoperability with funds flowing into projects like Babylon and others. This reflects a broader trend across the DeFi landscape, a culture defined less by pure speculation and more by community, utility, and innovation. While speculators and degens can still pump their bags, the space as a whole is becoming more relevant to the mass market. Naturally, the viability of a supercharged DeFi sector will depend on the stability of the protocols themselves. A note of caution is that hacks or exploits could dampen investor confidence and limit the expected impact of interest rate cuts on the wider space. This is likely more true now than in previous cycles, since today's investors have grown both more sophisticated and more skeptical. Meme coins rise. Still, falling interest rates tend to spur investor activity, increasing their appetite for assets with higher risk but greater potential returns. Case in point, meme coins, which have recently rocketed even in the absence of rate cuts. For instance, political finance, or PolitiFi, meme coins have surged as the U.S. election draws closer, with tokens playing on the names of political figures and movements such as Biden and MAGA, pushing PolitiFi's combined market capitalization above $400 million as of August 16th. Elsewhere, a Bitcoin-based dog meme coin, or DOG, became the largest asset launched on the Runes protocol, peaking at a market cap of nearly $1 billion. It's entirely possible that meme coins will go parabolic, especially if interest rates trigger a bull market driven by retail FOMO. The meme coin market is worth more than $30 billion as of August 16th. Of course, the inherent volatility of meme coins and their potential for sudden and often spectacular crashes will inevitably keep some investors on the sidelines, particularly if interest rate cuts are less substantial than expected or if regulatory scrutiny starts to mount. TradFi brings deeper liquidity. The entrance of spot crypto ETFs in the United States, not to mention their performance, has also piqued the interest of traditional finance, evidenced by billions flowing into Bitcoin ETFs. With many institutions already warming to the asset class, the net result should be deeper liquidity and greater regulatory support. It's easy to imagine Ethereum reaching a new all-time price high thanks to institutional inflows. Increased institutional participation in crypto goes beyond the pursuit of yield, though. TradFi players could show greater interest in stablecoins as a medium for payments and international trade, further reforming the industry's image as a speculator's paradise. On the other hand, the lack of comprehensive modern framework for digital assets in the United States, as well as the perceived risks associated with DeFi, may continue to hinder widespread adoption, regardless of interest rates. Naturally, these are just a few areas to watch. The actual impact of any rate cuts will depend on many factors, including regulations, geopolitical tensions, and investor sentiment. Our next top headline: Franklin Templeton files S1 for new crypto index ETF. Issuers are lining up for the next wave of cryptocurrency exchange trade funds. Asset manager Franklin Templeton is seeking to launch a new exchange-traded fund designed as a one-stop shop crypto portfolio, according to an August 16th filing. The Franklin Crypto Index ETF will track the performance of the CF Institutional Digital Asset Index, which currently only comprises Bitcoin and Ethereum, the filing said. The fund will seek to achieve its investment objective by investing in the digital assets in approximately the same weights as they represent in the underlying index. According to the filing, which says that the ETF may hold additional types of cryptocurrencies in the future, the Franklin Crypto Index ETF is an early entrant in the market for crypto index ETFs, which are emerging as the next area of focus for crypto ETF issuers after the launch of BTC and Ether. ETFs in January and July, respectively. It will compete with the HashDex NASDAQ Crypto Index ETF, which the first crypto index ETF to seek regulatory clearance. The next logical step is index ETFs because indices are efficient for investors, just like how people buy the S&P 500 in an ETF. This will be the same in crypto. Caitlin Tischhauser, head of investment research at crypto bank Signum, told Cointelegraph. Tischhauser said that crypto index ETFs are currently limited to BTC and ETH because those are the only digital assets the Securities and Exchange Commission has authorized to be included in ETFs so far. They intend to be an index as long as only Bitcoin and Ethereum are approved. That's what it will consist of, Tischhauser said. She added that demand is limited for new types of single asset ETFs, such as Solana ETF. Grayscale, the largest crypto fund issuer with $25 billion in assets under management, or AUM, also teased interest in getting in on crypto index ETFs. We're going to see a number of more single asset products, and then also certainly some index-based and diversified products, Dave Laval, Grayscale's global head of ETFs, said on August 12th. Before the ETF can trade on exchanges, the SEC must sign off on its registration application, called an S1, and permit at least one public equities exchange, such as NASDAQ, to list the product. So this concludes Crypto Top Headlines. If you haven't already done so, don't forget to click on the like and subscribe buttons as well as the notification bell. Also, leave your thoughts in the comments and share this video with your friends and family. Thank you all for watching Crypto Top Headlines, bringing crypto's news to you.